Ajay Srivastava, Managing Director at Dimensions Corporate Finance Services, joins us on the show now. Hi Ajay, good morning. Well, this Monday morning is not looking great for the markets at least.
Good morning.
We'll be getting cues from the global markets, FOMC meeting, Bank of England also meeting, and also back home, we've got the GST Council meet on 21st. We are bracing ourselves to the union budget as well. What's your market prognosis now at current levels, considering the index is off the all-time high levels that we've seen?
I think you should be happy that the index is at 11,000, almost 800, because given what's happening in the economy, it should certainly not be anything close to that number. And remember, we went up from 11,100, thereabouts, to 11,800. So, to worry about the fact that we're at 11,800 is it's a great stuff that index is at 11,800, given what's happening in the economy. That's one. The number two, of course, is that everything remains the same. Nothing changed in the market. The dichotomy between the small cap, mid caps and large cap continues. 10 large caps keep the index up, which is true because, factually speaking, as the economy slows down, the companies where there are lots of small competitors will do reasonably well compared to the rest of the economy, which is why people keep asking, why do you see Titan going up? Why do you see Bata going up? Why do you see other stocks? Because quite simply, their market share is changing dramatically. However, where there are only large players like cars or autos or two-wheelers in the economy, their problem is that all the share prices have to fall because the demand is split between only 3 or 4 companies, so everybody's taking the hint. So, it's a kind of a paradigm shift in thinking that an economic slowdown is leading to bigger and bigger rallies in stock prices of larger companies where they have faced stiff competition from smaller companies. All in all, we are happy with the index. I think it's wonderfully overpriced, if one was to say so. It's stable. That's one second part. Number 3 is the right companies are gaining traction more and more, to use your word. And come the small and the mid caps, people who are going to experiment will again have a problem in terms of when they enter and how do they exit out. So, small and mid cap has to become a mutual fund game because liquidity is very poor. So you will have to put direct money in the bigger stocks, and the smaller stocks have to go via the mutual fund. There is no choice.
Okay, Ajay, hi, good morning, Darshan here. Just a sense on, the housing finance space and the NBFC space in particular. If you can comment, the big block deal that has happened today is Piramal Enterprises most probably exiting Shriram Transport. Is that a matter of concern for you, indicating that, when large houses, large corporates also exit the NBFC space, is that a sign of worry?
Well, of course, there is a sign of worry. NBFC space is full of worries, and the worry is not that the NBFC is a problem. The worry is that there is no action on the side of the central regulators to ensure that there is an orderly conduct in the affairs. You can put ILFS and says you can't launch bankruptcy proceeding against it by a fiat, and therefore nobody can do, default cannot be put into bankruptcy. Otherwise, ILFS would have been declared bankrupt by now long back, and the process started. The problem is not NBFC. The problem is lack of regulatory intent to address the situation in the market. That's one. Number 2 is, let's say, assuming that sale has taken place of Piramal, that's not a big deal because at the end of the Piramal is also trying to bring money back to the own system because they're also literally an NBFC. At the end of the day, they have a large NBFC, they lend to real estate, they lend long-term market. So they also need to bring back the capital. So they can't be investing out, particularly after it is very clear that the merger which they had planned with the Shriram Group companies and themselves is not going through. So there is no reason for them to have a portfolio investment of any kind. So I don't think it's a great negative, but the industry itself is a great problem area today, and it's showing up in the economy, showing up everywhere. And as HSV is concerned, the good part is that there is no dearth of money available in the market for quality deals. So if you want to buy a house, you can certainly get the money to buy a house. Okay, that's not given to say. So to say that the problem which has happened is promoters. Promoter funding is where it's dried up, and that's where the capital investment gets hurt the most because promoters can't fund themselves. They're not going to expand. They're not going to do. All they're going to do is to deleverage their companies, take dividends, do whatever they can, and pay off their personal loans. You've seen what's playing out in Z, etc. So problem area is not HFC. Housing finance is perfectly fine. The problem area is promoter funding, and that's where the economic growth comes from. I don't think you have any issues in HDFC not able to find money to lend, or the other banks not able to give loans to housing finance. So that sector is not a worrisome at all.
So Ajay, what you're suggesting is the liquidity pressures that the industry was seeing after IL&FS crisis last September is easing off. Are you seeing signs of that?
Oh no, certainly not. It's not. I did not say easing out. All I said was that as far as the housing finance companies are concerned, there are enough large players to take care of the market requirement. I think that's the bottom line. The problem comes in the kind of a gray area customers who don't have enough earnings to show for, who have kind of stuff which doesn't qualify the criteria for, let's say, an HDFC, who used to go to an India Bull or who used to go to a DHFL, etc. Now they can't find a way to fund themselves. So yes, there is a problem on the set which doesn't meet the criteria of the main HFC companies. But in terms of liquidity crisis, is acute. Absolutely, there is no money for NBFCs, no matter what SBI chairman kept saying, I will do this and I will do that. The fact is, when we talk to everybody, there is no lending. There is that people just trying to pay off and keep cash in the bank. Look at the balance sheet of Edelweiss, look at the balance sheet of IFL. They're full of cash, not knowing when the next crisis will hit them. So they're not lending big time. They're all hoarding up cash today. Whoever is decent, half decent enough. Leave aside Bajaj Finance, I think is an outlier, but everybody else is hoarding cash, not knowing what this crisis will come into. And that's the sad part, that what could have been contained has now become like a industry-wise conflagration spreading across day to day.
What about the auto space, Ajay? Is that a matter of concern, the weakness that is there, or are you believing that the worst seems to be behind, or valuations certainly are reasonable now?
Well, I don't know. Auto. Let's divide the space. Auto car space. I think people have still a lot of hope in the leader Maruti, but that's not going to happen because one, the competition has gone up. Number two, you'll see the June numbers are going to be worse than May numbers, whatever we are saying. We may be wrong totally, but our indications say that June is going to be worse than May by any standards. So therefore, I don't think auto pain is gone for a minute, and the car pain is going to be bigger because now you got bigger players like Mahindra who was walked in, and now they've announced today joint venture with Ford, etc. So earlier, the market leader had a clear market for itself. Now it's going to be competing with Hyundai, not only earlier, but now with Mahindras and everybody else coming in. You've seen what's happened to the motorcycle space. It's now got 2-3 new competitors coming in. So auto is not just about volumes, it's also about margins, also about competition. I think we have to be ready for a downward re-rating of the industry because the competitive pressures more than just the volume, and the earnings will of course be not so happy because of the discounts. So it would be premature to call a bottom to auto in a market that is today in terms of fundamental, but in terms of liquidity, you can never know. You saw how the market went up from 11,100 to 11,000 to 12,000 with no economic reason to take the market up. So let's be honest, this is a market, and that's why we should make a decision based on liquidity, not necessarily on fundamentals. So to say it is priced in is yes, reasonably personal says priced in. I would say it is not priced in, but tomorrow liquidity gush comes in after the Federal Reserve meeting again into the economy, the price may go up. If it reverses, you'll see a dramatic fall in price. So our focus has to be more than the economy is the liquidity, what's coming in from overseas, because when that dries up, you see a market drying up totally.
Ajay, the other space which has been a laggard, not just this year, but last many years, is the pharma pack. The stock's been correcting. Majority of them are trading around their 52-week low levels. Valuations, of course, with the stocks correcting, have corrected too. Just solely on basis of lower valuations now, does it give you any sort of comfort in an environment where pricing pressures still exist? And the recent domestic data of the pharma companies, the sales for the month of May were at 19-month low.
Which was a surprise to me. How can a country like India, where our economy is growing, our income is growing, and access to health is improving, Ayushman Bharat has come on the other side, giving access to the lower end of the population, it's just not understandable that how can prices of the total sales of medicines go down. So I'm not sure exactly that what is happening in the economy, but quite obviously something serious is happening underlying, because one is the price controls which are keeping the products off the market, which is one of the worrisome, not only in India and the US as well. And second is, in terms of pure valuations, you are absolutely correct. These companies are dirt cheap today, and there is a wide difference between the deals going in the private equity space and the deals going into the listed space. So if any of the companies, the bigger companies also, pharma, would probably go for delisting, you'll find the valuation moving dramatically. So in terms of pure value, 2 to 3 times book value for so much of intellectual assets in the company, it's a steal absolutely. But whether the turnaround is round the corner will take another year, I don't have the answer. But is it a good entry point? I would say you are at least safe that how much worse can happen to this company, that beyond 2 to 3 times book value, you really don't have to worry too much. Sun Pharma, of course, to be honest, has got a different set of issues, promoter issues, inside the dealing with the dealer, which is a relative, and so on and so forth. So it has battling a different set of issues. But if we talk of other companies like Glenmark, etc., I think valuation is dirt cheap in terms of what they carry on their books. But whether the turnaround takes place, no. And as far as demand, local demand is concerned, it just bothers me that if that is what is happening in the economy, if people are not able to buy medicines, then where will they buy the cars from?
Okay, Ajay, we'll leave it at that note. And thank you very much for joining us this Monday morning on
Thank you very much for having me.